The IRS announcing it's raising income thresholds for all the tax brackets and increasing the standard deduction.
Tonight, the massive IRS tax leak. It has revealed the wealthiest of Americans paying little to no federal income tax.
ProPublica news outlet, the 25 wealthiest Americans pay tax at a far lower rate than the average worker.
Today's video, we delve into recent IRS announcements targeting high-income earners and the complexities surrounding tax enforcement. Join us as we explore the nuances of tax compliance, budget constraints, and the pursuit of financial fairness in our society. In the last few weeks ago, the IRS announced its pursuit of 125,000 Americans who, according to their records, earned over $400,000 annually but failed to file tax returns. This enforcement effort could potentially recoup as much as $100 billion. While the IRS is now taking action against individuals who haven't fulfilled their tax obligations since 2017, many wonder why it has taken so long for these measures to be implemented if the agency was aware of these individuals' tax evasion. Despite the perception of the IRS as an omnipotent entity, the reality is that the department is facing challenges due to being underfunded and understaffed. Consequently, it must prioritize its efforts to maximize its limited resources. Over the years, politicians from both parties have slashed the IRS's budget, complicating its ability to effectively enforce tax laws. Simultaneously, the tax code has become increasingly intricate, allowing affluent taxpayers with diverse income sources to exploit various deductions, offsets, credits, exemptions, and deferments. Given these complexities, verifying the accuracy of tax filings often requires individual assessment by trained agents. However, the IRS lacks the manpower to conduct such thorough examinations, leading it to rely heavily on taxpayers' honesty when processing complex returns. The IRS must prioritize its budget based on maximizing returns, often targeting easier audit subjects. ProPublica's report reveals that individuals earning $20,000 are more likely to face IRS audits than those earning $400,000. The Earned Income Tax Credit, EITC, is a key focus due to its simplicity in claiming for low-income earners. However, if audited, individuals must prove EITC eligibility. The income threshold is $17,640 annually for singles and up to $63,398 for married couples with 3 or more children. Many qualifying individuals lack resources to contest audits, leading to compliance with IRS determinations. This makes EITC audits the most successful, driving continued focus. Despite this, the IRS's stretched resources raise questions about targeting low-income earners for relatively minor amounts. Pursuing larger sums owed by the wealthy may seem more logical, but reality complicates this view. The recent IRS announcement about targeting non-filers with incomes as high as $1 million annually may seem like progress, but there are 3 reasons why this initiative has been delayed and may not yield desired results. Firstly, the IRS acknowledges that over a decade of budget cuts hindered its ability to keep up with the complex tactics used by wealthy taxpayers to evade taxes. To cope with limited resources, the IRS drew inspiration from online gaming strategies. Consider when cheaters persist in online games without immediate repercussions. This delay in action could be due to developers prioritizing new releases or waiting to enact a mass ban on cheaters. Similarly, the IRS has been compiling a list of suspected tax cheats since 2017 for a crucial reason: the 6-year statute of limitations on tax fraud convictions. By auditing 6 years' worth of suspected tax fraud simultaneously, the IRS aims to increase revenue in 2 ways. Firstly, it hampers tax professionals' ability to exploit new loopholes, making it easier for the IRS to collect back taxes for at least 6 years. Secondly, by tackling multiple years of potential fraud at once, the IRS aims to recover more funds than if it had addressed only 1 year's worth of discrepancies. Another method the IRS is leveraging to increase revenue is through the failure to file penalty. This penalty charges filers 5% of their unpaid taxes for each month the return is late, up to a maximum of 25%. Additionally, the IRS can apply interest on unpaid taxes and penalties, effectively using unpaid taxes as a high-interest savings account. However, if you believe this signifies the IRS targeting the right individuals at last, there's a disappointing revelation. Understanding how money works sheds light on why the IRS has taken so long to pursue high-income earners and why it may not lead to significant change. The key factor enabling the IRS to target wealthy individuals now is evident in their press release: temporary funding provided by the Inflation Reduction Act. This funding boost allows the IRS to conduct substantial audits, a capacity they typically lack due to budget constraints. With resources from the Inflation Reduction Act, the IRS can now fulfill its core tax administration duties, including identifying non-filers and ensuring compliance with tax obligations. This initiative aims to promote fairness for all taxpayers adhering to the rules. The IRS is implementing various initiatives to enhance tax compliance in previously neglected areas due to insufficient resources before the Inflation Reduction Act funding. It's not common to witness public servants scrambling for funding just to fulfill the basic requirements of their jobs. Despite additional funding from the Inflation Reduction Act, the IRS budget remains constrained, merely returning to 2013 levels, while simultaneously facing a 10% reduction in its overall workforce. Moreover, the IRS is now tasked with auditing a larger population due to population growth. Cutting IRS funding in attempts to trim the federal budget is akin to saving money by skipping work. While it may save on immediate costs, it ultimately results in the loss of income. A study by the Congressional Budget Office indicates that increasing the IRS budget could lead to a substantial increase in net revenue annually, potentially by 500% to 900%. However, influencing federal budget policy typically requires significant wealth to fund congressional election campaigns or ingratiating oneself with affluent supporters. Understandably, these individuals are generally uninterested in budget allocations that would increase their tax burden. Insufficient funding is the second reason why the recent announcement of the IRS targeting millionaires should not evoke excitement. According to Glassdoor, the median salary for an auditor at the IRS is $75,000 per year. The IRS hiring guidelines specify a requirement of a college degree in business, finance, or economics, along with at least 5 years of experience in tax accounting or a PhD in accounting, auditing, or taxation. However, for a similar role in the private sector, the salary is nearly double, highlighting the stark pay disparity between government and private sector jobs. While government jobs typically offer greater stability, budget cuts at the IRS have jeopardized job security for employees. Qualified accountants and auditors with the skills to decipher complex tax returns can earn significantly higher salaries and enjoy more career stability in the private sector. Despite the presence of talented individuals at the IRS, their motivations are often not solely driven by personal interests. A report by the Taxpayer Advocate Service, an independent office within the IRS, identified the lack of sufficient and highly trained employees as the most pressing budgetary issue in America. This shortage of skilled personnel contributes to a substantial tax gap, with an estimated $580 billion in unpaid taxes in 2019, projected to increase to $7 trillion by 2029. The recent IRS announcement targeting certain non-filers aims to recover an optimistic $100 billion, according to the agency's estimates. This announcement may not be as positive as it seems, mainly because the IRS is still targeting relatively easy marks. The millionaires the IRS intends to audit under this latest initiative are primarily 1099 private contractors who operate their small businesses where they are the sole employees. This tax structure is commonly found among gig workers, independent tradespeople, and consultants who work for themselves. While it's important to ensure these individuals pay their owed taxes, their taxable income after deducting expenses is often much lower than their six-figure revenue. For instance, an independent electrician billing $400,000 annually must cover costs like supplies, tool maintenance, merchant fees, fuel, insurance, and advertising before taking home any income. Even if a 1099 contractor fails to file a return, they're still known to the IRS because the companies they contract with report them as expenses to reduce their own tax liability. These individuals are typically not the sophisticated tax evaders the IRS portrays them to be. Instead, they are often small business owners who struggle to keep accurate financial records. Thank you for joining us to explore truly wealthy and sophisticated tax cheats who would never risk not filing their returns. They meticulously prepare their returns with the help of large teams of accountants and tax lawyers who swiftly refute any auditor questioning their numbers.